As the IMF and World Bank meetings get underway here in Washington, in years past, the IMF has been really concerned about the future of the global economy. They've been sounding the alarm, and this year they are sending a different message, that they're much more focusing on the fact that growth has returned to the major economies. And yet there are still underlying concerns such as low demand. What can the IMF do about this?
The IMF is in its role as providing advice to policymakers across the world, both monetary policy institutions, central banks, and finance ministries and governments. So the message of the IMF is structural reform is important. The demand landscape is more benign than it was in recent years, but the supply landscape is actually a concern, which in other terms means economies in both advanced economies and in a number of emerging economies. The economy is not dynamic enough, it's not vibrant enough. The potential for growth could be enhanced by targeted policy reform in microeconomic structures. And that is true for most advanced economies, especially in the euro area. It's true in China, it's true in a number of other emerging economies. So that is one of the main thrusts of the IMF. The IMF doesn't have policy instruments to address this, except in a limited number of countries under program. But as I said, it is perfectly legitimate to give this advice, which to me is sound advice, to governments across the world.
Monetary policy is being discussed around the world. Does the IMF have a message on monetary policy?
I think the IMF is highlighting something that is very much on the investor community's agenda, which is the tightening of monetary policy conditions in the US. So the Fed is in its program of tapering. That means a tighter financial environment globally, all things equal, and clearly the Fed's policy has global impact, even so it's designed for domestic outcomes in the US. Now, the IMF is also fully aware that the situation in the Eurozone in particular is very different, and therefore the ECB might even go into quantitative easing, unconventional monetary policy, which it has avoided so far, even at a time when the Fed is retrenching from quantitative easing. So we don't have a global cycle for monetary policy, certainly not between the dollar, the US and the Eurozone. And then the analysis, I guess, is different in different jurisdictions. The IMF, in my understanding, has been broadly supportive of the very expansive monetary policy of Japan. We'll see how this one evolves, and it goes back to the question of structural reform, because the IMF, like the Japanese government itself, is highlighting the fact that structural reforms, the so-called third arrow of Abenomics, has to come if a sustainable growth trajectory is to be found in Japan. So I would say it's a mixed picture, but the dominating theme of this year is the tightening of monetary conditions in the US.
One of the things that has been said already at the IMF is they consider what the Federal Reserve has been doing here in Washington is the normalization of monetary policy. Is the IMF concerned about the impact of the Federal Reserve's monetary policy on emerging markets?
So IMF is pretty sanguine on this. Some investors are very concerned about the impact of this tightening of US monetary conditions on emerging markets. The message of the IMF is actually don't worry too much, because emerging markets are very diverse, and it's really about individual country by country assessments and not a broader emerging markets trend, which I think is very reasonable. The question being, will investors in capital markets reason that way, or will they have more of a herd behavior? And we have seen a bit of a herd behavior in previous episodes. So the IMF is pushing investors to look at the fundamentals, to differentiate across countries, which I think is fine. It remains to be seen how this advice will be followed by global investors.
Here in Washington, there's been a lot of attention paid to the Ukraine, to Crimea, to Russia, to the crises in Syria, the talks between the Israelis and the Palestinians. Does the IMF have rising concerns about the geopolitical risks to the global economy?
So IMF notes that geopolitical risk has not materially changed the global macroeconomic outlook at this point. But they flag geopolitical risk, they highlight it in their presentations, and indeed there is a possibility that in Ukraine and possibly in other hotspots around the world, in Asia, the Middle East, and and of course everything around Ukraine, that you could have a material impact on future growth prospects. But in the IMF's assessment, it's not the case yet. So things would have to get worse, basically. Geopolitical risk would have to materialize in a worse manner than is currently the case for this scenario to become the baseline scenario.
And last of all, one of the emerging issues is global economic inequality. The rich are getting richer, the poor are getting poorer. Does the IMF, can they do anything about this? Do they have a message about global economic inequality?
Inequality is a different sort of theme. It's much more for long-term concerns that the IMF is highlighting. It's not for the next quarter, it's more sort of a medium to long-term perspective, whereas they're really raising the issue as something that could put a drag on global growth. And economic analysis, of course, is still, there are a lot of debates and even controversies on this, but the IMF is flagging a concern more than making a specific quantified assessment, or let alone making a specific recommendation. Now, there is a fine line to be found by different countries, and each country is a bit different in terms of how they can create redistribution mechanisms, safety nets, and welfare systems that address, to a certain extent at least, this inequality issue without crippling the economy and making the economy much less competitive. And this depends on different stages of development, but it also depends on technological developments. And I think the main message of the IMF is we have technological developments out there, they're global, and they create an environment that generates more inequalities than what a lot of us have been used to. So it's really a long-term concern. It's perhaps a new rhetoric from the IMF. There might be political overtones to it. It's a sensitive issue, of course, and I wouldn't frame it in the immediate short-term outlook.